Good morning, welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Thursday, March 12th, 2009. It's 11:30 a.m. Eastern Daylight Time in the U.S. It's 3:30 p.m. in London, 12:30 p.m. in Bermuda. In Mexico City, it's 9:30 a.m. If you need to contact us during the show, you can call in toll-free at 1-866-67-CATEX. Overseas, our instant mail address on AOL is CATEX-TV. 1 year ago today, Eliot Spitzer, the governor of New York, resigned after a sex scandal with prostitutes. Mr. Spitzer is slowly resurfacing. He is an online correspondent for Slate and also has been seen in public a few times purchasing buildings on behalf of his family real estate firm. Today's birthday list is unusual. Edward Albee, Liza Minnelli, Mitt Romney, James Taylor, Jack Kerouac, Carl Hiaasen, and Darryl Strawberry were all born today. We have some breaking news. Some is very big news from the financial industry. Just before we came on, Standard & Poor's announced that they were cutting General Electric's sacred AAA rating down to AA+. So General Motors has been cut. This despite all of the maneuvers and efforts by Jeffrey Immelt. S&P brings them down to AA+. The stock market is still up about 70 points. This is after a very, very modest gain yesterday, but at least did not give back everything from Tuesday. One other bit of breaking news. This is coming from the Canadian Broadcasting Company. A helicopter with 18 people aboard crashed in the Atlantic Ocean off of Newfoundland this morning. Search and rescue operation is underway. Life rafts have been seen in the water. It's not yet known, or it has not been reported, whether this is a civilian helicopter or a military helicopter. However, at this time of year, the ocean off of Newfoundland has got to be life-threatening, to say the least. Now to our news. Once again, it's Bernard Madoff. Madoff has pled guilty to all 11 federal charges. He arrived at the New York federal court this morning at about 7:15 a.m. Here's a picture of him arriving. He pled guilty at about 10:30 a.m., about an hour ago, and he's now listening to a succession of witnesses, or actually these are people that he defrauded. I'm sure that it's going to be a very emotional hearing in there. We have no information as to what's going on yet, but he did not admit to a conspiracy. And as a result, he was not able to negotiate a deal. He had no interest in negotiating a deal. He went in and pleaded guilty to all 11 counts that he had facing him. He could receive up to 150 years in prison. The sentencing has been scheduled for June the 16th. It's not yet known whether he's going to be held over in federal custody until the 16th. We'll talk about that a little bit later in the broadcast. Madoff had about 4,800 investors. He claimed at the time back in November to have swindled them out of some $64.8 billion. Prosecutors working for the district attorney in Manhattan said that they do not believe that Madoff acted alone, and they do expect to have subsequent indictments as well with other people in Madoff's firm. Madoff's brother, his wife, and his two sons worked with him at the firm, and each of those parties, through their attorneys, indicated that they would offer no comment. But it's thought that these are the people that the government will be focusing on. In downtown Indianapolis this morning, a massive fire broke out at an apartment complex. The complex was under construction. Fortunately, no one lived there. It started at about 3 a.m. 150 firefighters were on the scene through the morning. Mainly from 8 a.m. they were dealing with heavy smoke. Most of the flames had been put out. It's been confirmed that the complex is called the Cosmopolitan. It's a group of downtown luxury apartments which covers an entire city block. Large chunks of the building fell directly into the canal along which one of the sides of the city block's borders. The developer of the complex is called Flaherty and Collins. Flaherty and Collins say that they put $28 million into the properties. A huge concern had been that flying embers coming from the fire would cause the Indiana State House to erupt in flames, but the State House is in fact safe. Some economic news. The government announced this morning that retail sales fell in February for the 7th time in the past 8 months, but the decline was less than expected. This coming on top of comments by the CEOs at Citibank and J.P. Morgan Chase the other day that things are looking up in their business. The Commerce Department reported this morning that retail sales edged down only 0.1% last month. The general consensus from economists have been expecting a 0.5% drop. The government also revised January's performance to show a 1.8% rise. This is the biggest increase in 3 years and stronger than the 1% gain that they had originally expected. If you've been concerned about how the recent economic downturn has been affecting the value of your home, your IRA account, and your 401k account, you've probably been reassured by the fact that you don't have to mark those assets to market anytime soon. You don't need to do it until you retire. If you're a bank or a financial institution, you don't necessarily have that luxury. You have to mark to market on a regular basis. So as a result of the falling economy, your real estate portfolio plummets. Today in Congress, about an hour and a half ago, it began a subcommittee hearing is going to be examining the accounting rules that force banks to value assets at current prices even if they do plan to hold on to them for years. The campaign to suspend the so-called mark-to-market rules is being waged by bankers, House Republicans, and industry-friendly Democrats. Banks, large and small, have foundered and failed. The banking industry has been devastated by the write-downs. It's been forced to take on mortgage-backed assets since the collapse of the housing market. The chairman of the committee, Representative Paul Kanjorski of Pennsylvania, says, while companies need stability, investors still need accurate information. We therefore cannot allow for fantasy accounting that wishes away bad assets by merely concealing them. However, I want to find a way to provide investors with the information they need to make effective decisions without continuing to impose undue burdens on financial institutions. Proponents of mark-to-market rules argue that suspending or scrapping them would weaken transparency in companies' financial statements. Critics say that the rules mandate onerous write-downs that don't reflect the true value of soured mortgage-linked assets and the prices they may fetch in the future, presuming their value increases. Another big drug company acquisition, this time it's Roche, formerly Hoffmann-La Roche in Basel, Switzerland. They said this morning that they've sealed a friendly deal with Genentech to buy the 44% of Genentech that Roche did not already own. Roche is going to pay $46.8 billion for the stake. This is after they raised their offer price to $95 a share. Roche has been preparing to finance the deal after it successfully placed a number of bond offerings in various currencies, raising nearly $40 billion over the past months. On Friday, Roche increased the offer price to $93 a share. That higher offer finally brought Genentech's independent board of directors to the table. With intense talks that lasted all weekend, the agreement finally came in at about $95 a share. According to Charles Sanders, chairman of a special committee of independent Genentech board members, we believe this is a fair offer for Genentech, and we look forward to working with Roche. Listen to this. Roche already once owned all of Genentech when it had acquired the then small U.S. biotech firm in 1990 for $2.1 billion. But the Swiss drug maker reduced its stake to 56% in several steps a decade later. Now they paid some $47 billion to get it back. The close collaboration with Genentech has been key to Roche's success in recent years, with all of Roche's best-selling cancer drugs coming out of the California-based biotechnology company's drug pipeline. We always hear about how General Motors and Ford and Chrysler might be too big to fail, and the reason is because of the suppliers that stand behind them. Well, yesterday in Washington, the head of Toyota's U.S. group came into Washington and warned the Obama administration that Toyota is seriously concerned about the financial health of about 20% of its own parts suppliers. Jim Lentz, the president of Toyota Motors U.S., told members of the administration's auto industry task force that as many as 100 companies that provide car parts to Toyota are entering a crucial period that could determine whether or not they'd survive. The suppliers are suffering as well from a prolonged slump in U.S. auto sales, and car makers worry that a collapse of even a few of them could have an industry-wide impact. Lentz told reporters after the meeting that the biggest challenge we face is really in the supply